What's up, everybody? If you have been following the channel, you know that I am very bullish on the healthcare sector. We've looked at a bunch of companies in the space over the past couple months. I own Elevance as my largest position. I also own UNH and CNC. I've sold some puts on Molina, so I may be entering a position here. And today I wanted to do a quick video looking at all of them. We're also going to look at Oscar in the mix too. That way, if you just want to get a quick overview of how I see the risk and reward of these companies, this is the spot. If you want a deeper dive, you can go into my individual videos on each of these companies. I'll link that in the description. By the way, I am traveling and in a hotel right now, so I apologize if the audio is a bit more echoey than normal. As always, if you get value out of the video, subscribe to the channel. And if you want to make spreadsheets like these, I hope you consider supporting me on Patreon. You can get my template and also get access to my custom Google Sheets add-on, which will allow you to just put in a ticker symbol in here, and then you'll hit load, and it will load up all this data and make a nice little sheet for you. Now, let's get into it. Before we dive into the numbers and see, what we could expect for a return on our investment, I just want to highlight the difference in size of these companies and also the difference in which segment of the health insurance market are they targeting. Here in the US, there are a bunch of different sub-segments of health insurance. So you have Medicare, that's the orange here. That is a government program. It is run by the federal government. This is primarily for older people, senior citizens. You also have Medicaid, that's a teal here, also a government program, but it's run by the states. States get somewhat reimbursed by the federal government. This is for lower income individuals. You also have employer-sponsored plans. A lot of people get health insurance through their company that they work for. That's broken down even further into just the administrative services. So that's this pink section right here. And this is where a company, maybe take Elevance or UNH as an example, where they're administering the plan, they're managing the plan. But as far as the financial risk is going to fall with the company, the employer themselves that this plan is under. You also have fully insured employer-sponsored plans. That's this purple right here. And that's where the insurance company, they're not only administering, managing the plan, but they're also taking on the financial risk. And finally, the last major subsegment we're going to talk about here is the marketplace, and that is the dark green that you see down here. If you are an individual and you are getting your health insurance at healthcare.gov, you are likely getting a marketplace plan. And as you see, these companies, they focus on very different segments of the market. I don't have Oscar on this graph, but if I did, it would be almost entirely marketplace. Oscar is one of the few health insurance companies where the vast majority of their membership is coming from the individual marketplace. Now, I want you to understand this because as we go through these companies, I don't consider all these subsegments to have equal amounts of risk. Employer-sponsored plans tend to be higher margin, tend to be more reliable customers. Medicare may be one step down, margins a little bit lower than employer-sponsored plans usually, but membership is also fairly consistent. Unfortunately, someone is not elderly one year and not elderly the next, so once you have someone on a Medicare plan, the churn tends to be fairly low. In contrast, Medicaid, people are jumping in and out of Medicaid eligibility fairly frequently. Churn is high, margins are very low in this segment. And then finally, you have the marketplace, which is a little bit of a wild card. It has some unique pressures, and with federal government subsidies to the marketplace likely expiring at the end of this year, it is, for me, the hardest one to forecast going forward. If you want more information on the marketplace, you should probably watch my video about Oscar. Since they're completely exposed there, I talk a little bit more about it in that video. Now we're gonna look at these companies in order of what I consider most predictable to what I consider least predictable. So we are gonna start with UNH, the largest player. Across the board, margins of all of these companies have been under pressure. They all significantly underestimated where costs were going to be for this year, and pretty much for all of them, they underpriced their plans. My base case for all these companies, and what is core to my thesis here, is demand for healthcare is only going to go up over time. Revenue for all the major healthcare players, it's going to go up and to the right. The question mark is profitability, margins. Are they going to recover? Are margins in the future going to be similar to, what they were for most of the past decade? Or is 2025 just a new normal? The future is going to look like 2025 and margins are going to be low for all of these companies. I don't buy that scenario. They are going to increase rates, and that's pretty much regardless of what subsegment you're looking at. Medicare rates, they're going up. Medicaid rates, you listen to the earnings calls of Elevance, Centene, Molina, they pretty much say similar things. Their Medicaid bids are factoring in a significant increase in rates. So my base case assumptions for UNH are revenue grows high single digits, operating margin doesn't even fully recover to where it's been, the past 5 years. Free cash flow margin stays low for the next couple years, then rebounds, and I'm just giving them a 12 times multiple. This isn't a demanding scenario, and you are looking at more than a double on this stock over 5 years. My bear case, which for all of these companies, my bear case is essentially we are in a new normal. Healthcare is not going to recover to what it has been over the past decade. And the numbers I put in to reflect this story here are, revenue is still going to grow for UNH, but just 5%. Operating margins, they are going to contract even more. And free cash flow, no free cash flow this year, only gets to 4% and just a 9 times multiple. This would be extremely low for this company, and in this scenario, you are essentially flat on your money over 5 years. Now, my bull case for pretty much all these companies, except maybe Oscar, they're a little bit of a different story, is that the next 5 years pretty much just look like the past decade. The numbers I pick for growth, margins, their multiple that they're going to be trading at, 16 times multiple, these are all fairly in line with what the company has done in the past. So in this, the market fully recovers from 2025 scenario, you're looking at almost a 30% annualized return on UNH from here. This is more than a triple, and it's not some crazy scenario. The bottom line is, I think the risk reward for UNH is quite good. I think it was a lot better when it was in the mid 200s. The stock has bounced back a decent amount over the past month, but I think there's still a lot more room to run. I'm certainly not planning to sell my shares anytime soon. I'm happy to hold UNH. Now, Elevance. This is currently our largest holding in the healthcare space, and when you look at the numbers, I think you'll see why. In my ugly bear case of, health insurance companies never recover. They just grow revenue in line with inflation. Margins remain under significant pressure. I'm giving them no credit for free cash flow for 2 years in this scenario. And then I'm only giving them a 9 times multiple. And in this case, you're still looking at a 4% annualized return. For a pessimistic bear case, this is quite good. And if they have a full recovery, if the next 5 years are pretty much just business as usual, you are looking at more than a quadruple on this stock over 5 years. Even if I give them a 13 times multiple, this is still close to a quadruple. My base case is a bit of an in-between. Revenue, not quite as high as they have been. Margins bounce back, but not fully. I'm giving them a 12 times multiple. You're looking at a bit under a triple. If margins only came out to be about 5%, still, you're looking at a 19% annualized return on this stock over 5 years. I think the risk reward on Elevance is extremely good. And recently I was asked a question in a video, if you think Elevance is great, why not just invest in Elevance? Why have money in UNH and Centene and possibly Molina? In any case, why not just invest in Elevance? Well, the core of this question is, how do we determine the allocations in our portfolio? There is no one right answer. People have different risk tolerance. But for me, I don't want any one position in my portfolio to be too large a percentage of my total pie. At least when I look at cost basis. If I buy for a small amount in a company and then it grows and becomes, a much larger position in my portfolio, I might keep it, I might trim it. That's another discussion. But I don't want to buy in for, 10% of my portfolio typically to a company. Usually for me, I don't want to buy in for more than 5%. The fact of the matter is, no matter how confident I am in Elevance, no matter how many numbers you put into a spreadsheet, you can always be wrong. I can always be wrong. In fact, I guarantee that I will be wrong about some of the companies that I present on this channel. It's an inevitability. It's something we have to accept when we invest. We would like for our thesis to be correct, but that's just not going to be the case. Now, what I would be really upset about is if my overall thesis around healthcare is correct, but there's something in particular about Elevance that I've just missed that I'm not considering. I'm confident enough in my thesis on healthcare to allocate a larger than 5% stake of my portfolio to this sector. But I don't wish that allocation to be all in one company. When I'm looking at other opportunities, Centene, UNH, especially UNH when it was under $300 a share, that I think they're offering excellent risk reward as well. So yes, I might have a favorite. Today at current prices, it is Elevance, but I'm bullish on all of these companies. So I want a larger exposure to the sector without too much exposure to one individual name. Now, moving on to Centene, we're getting into riskier companies here. Centene, Molina, Oscar, these are smaller companies than UNH and Elevance. They don't have significant health services businesses to buffer out the health insurance side. These are pretty much pure play health insurance companies, and they also target different segments. Centene and Molina both focus on Medicaid, with also some exposure to the marketplace. Margins are are lower for these companies, and also my bear case for both of them is no revenue growth over 5 years. There are possibly going to be Medicaid cuts in the future. The government is very likely changing eligibility requirements for Medicaid. Now, I think the end result of possible changes around Medicaid here is not going to be as bad as some people fear. If you listen to Molina's call, hear how management talks about it, which again, they would probably know better than anyone in this industry. They say they're forecasting a 15 to 20% reduction in their Medicaid expansion book. And Medicaid expansion, again, if you want more detail, you can go into the Molina video, but that's probably not even 30% of their total book. So we're talking about a 5% reduction in the top line here compared to where they would have otherwise been. I think I'm taking that into account with my numbers that I'm putting in here. So for Centene, my ugly, they never recover scenario, revenue is flat, operating margins 1%, no free cash flow for 2 years, just a 7 times multiple. I mean, this is really ugly. And over 5 years, yeah, you would be down a little over 20% on your money. That wouldn't be fun, but the upside with this stock, if they recover, if they make a full recovery, they get back to 2.5% operating margin, I give them a 13 times multiple, which yes, would be high for them, but this is my bull scenario. You're looking at almost a 15% annualized return over 5 years. You would be up about 600% on your money in this time. This is the upside that is available to us with Centene. This is why I own this stock. And honestly, this is kind of the heart of deep value investing. Yes, when we're wrong, it's not going to be good, but I don't think I'm going to go broke when I'm wrong. And when I'm right on a deep value investment, you get greatly rewarded. Your winners often more than offset your losers. Molina, kind of a similar story to Centene. I think in the bear case, the scenario where healthcare does not recover, I don't think we're losing much here. If they do make a full recovery, if the future looks like the past as far as growth and margins, and I just give them a 12 times multiple, which yes, for this company, that would be high. It is my bull case, but in this scenario, you're looking at roughly a quadruple on this stock. If the changes in Medicaid eligibility or in funding hurt Molina more than I think, then, there is risk here. I personally wouldn't want to have a massive holding in Molina, but I think the risk reward is good. And for a small position size in my portfolio, I think Molina is a fit for me. So for these 4 companies, if you compare the numbers that I put in for UNH, then, Elevance, Centene, and all the way down to Molina, you see that I've pretty much been dropping the multiple that these companies are trading at in my base, bear, and bull case as I go from more predictable, what I consider to be lower risk companies to the higher risk names. I think this is pretty reasonable. UNH deserves to trade at a premium, then probably Elevance. And Centene and Molina should probably have multiples that reflect the increase in risk. Now, let's get to Oscar, because this is a little bit of a different beast. They're the only real growth company here. The top line has really just exploded over the past 5 years. They are almost completely exposed to the individual marketplace. Again, if they were on this chart, they would be pretty much this dark bluish green thing down here. They have greatly benefited from increased government subsidies to the marketplace that were put in place post-COVID. These subsidies are probably going away at the end of 2025, so I'm not sure what's going to happen to this growth in the future. Furthermore, I'm not sure where margins are going to be at. Oscar is about to flip into profitability. In fact, they were briefly reporting positive operating income, and then, costs came in pretty high this year, and operating income is currently negative for the trailing 12 months. But, management is signaling that they can get to 5% operating margins. And if they do, and if growth continues the way it has been, Oscar is going to be a huge winner. I mean, if they continue growing, 20-ish% on the top line with 5% operating margins, yeah, you're probably looking at, a 5x on this stock over 5 years. So if you have high conviction in a scenario similar to this, I understand why you would own Oscar. But for me, there's just too many question marks here. They've gained market share by extremely aggressive pricing in the marketplace. I'm not sure how easy it's going to be for them to get to 5% operating margins. And if marketplace subsidies are rolled back, the overall marketplace enrollment, marketplace membership is probably going to decline. Even if Oscar continues taking market share, that's going to be a pretty significant headwind. You can see that the difference in numbers I put in for the bear and bull case is huge. For revenue growth in the bear case, I was forecasting a decline of 5% every year, and this is in the scenario that subsidies go away, marketplace enrollment significantly drops, they can't get to 5% operating margin, only 2.5%, which again, they're not profitable right now. So this is forecasting a margin improvement. I'm only giving them a 7 times multiple, which is, pretty much in line with Centene and Molina or the other names that I consider high risk. And in this scenario, you're down 20% on your money after 5 years. It's not that I think that this is the end of the world. It's that I do not have conviction about where Oscar is going to end up in these scenarios. I can't say for certain that this bear case is extremely unlikely. I just really don't know. As opposed to, Elevance, where when I put the numbers in for their bear scenario, I think that the bear case here is unlikely to happen. Still a possibility, just not very probable. With Oscar, I don't have a sense. I'm not buying the stock. At this time, this company is not a fit for me. So that's the way I see it. Those are my thoughts on these companies. If you got value out of the video, subscribe to the channel. If you agree or disagree with anything I said, put that down in the comments below, especially if you own one of these stocks. Let me know, what are your opinions on the sector, on the individual names here? And again, if you want to make these spreadsheets yourself, I hope you consider supporting me on Patreon. If you try it out and you don't like it, just shoot me a message, an email. I'll refund the money for the month that you paid. So don't worry about it. And in either case, I hope to see you all in another video.